Hi, welcome to wasidu.com. My name is Suhartina. Let me be the presenter of this material. And in this section, we will study about what is account. Account is an accounting record of increases and decreases in a specific asset, liability, or equity item. For example, a company would have separate their account for cash, account receivable, account payable, service revenue, and salaries expense. In its simplest form, an account consists of three parts. First is a title, second is a left or debit side, and third is a right or credit side. Because the format of an account resembles the letter T, we refer to it to a T account. The T account is a standard shorthand in accounting, which helps make clear effect of the transaction on individual account. We will use the T account to explain basic accounting relationship. Now is debit and credits. The terms of debit and credits are directional signals. Debit indicates left and credit indicates right. They indicate which side of T account a number will be recorded on. Entering an amount of the left side of an account is called debiting the account. Then making an entry on the right side is crediting the account. We commonly abbreviate debit as DR and credit as CR. Having debits on the left and credits on the right is an accounting custom or rule, like the custom of driving on the left-hand side of road in the United Kingdom. This rule applies to all the accounts in accounting. Debit and credits procedure. In accounting, each transaction must affect two or more accounts to keep the basic accounting equation in balance. In other words, for each transaction, debit must equal credits in the account. The equality of debits and credits provide the basis for the double entry system of recording transaction. In the double entry system, the dual or two-side effect of each transaction is recorded in appropriate account. This system provides a logical method for recording transaction. It also helps ensure the accuracy of the recorded amount. The sum of all debits to the account must equal the sum of all the credits. The double entry system for determining the equality of the accounting equation is much more efficient than plus or minus procedure. assets and liabilities. Remember that both sides of the accounting equation must be equal. It follows that we must record the increases and decreases in asset opposite from each other. Therefore, we must enter increases in liabilities on the right or credit side and decreases in liabilities on the left or debit side. This illustration summarizes the effect that debits and credits have on assets and liabilities. Debits to a specific asset account should exceed the credits to that account. Credits to a liability account should exceed debits to that account. The normal balance of an account is on the side where an increase in the account is recorded. Thus, asset accounts normally show debit balance and liabilities accounts normally show credit balance. These illustrations show the normal balance for assets and liabilities. We can see in here that the normal balance of asset is on the left side and the normal balance on liabilities is on the right side. Because if asset is increased, we must write it on the debit, and if asset is decreased, we must write it on the credit. But if liabilities were decreased, we must write it on debits, and if liabilities were increased, we must write it on the credit. Knowing the normal balance in an account may help you to trace the error. For example, a credit balance in an asset account, such as land, would indicate a recording error. Similarly, a debit balance in a liability account, such as wage payable, would indicate an error. Occasionally, an abnormal balance may be correct. The cash account, for example, will have a credit balance when a company has overdrawn its bank balance. Now we move to the equity relationship. Let's see the diagram below. Remember that the companies report share capital ordinary and retained earnings in the equity section of a statement of financial position. They report the dividends on the retained earnings statement, and they report the revenue and expense on the income statement. Dividends, revenue, and expense are eventually transferred to the retained earnings at the end of the period. As a result, a change in any one of these 3 items affects the equity. The last is about revenues and expenses. So, what do you know about revenues and expense? First, we must know about the purpose of revenue. The purpose of earning revenues is to benefit the shareholder of the business. When a company earns revenues, equity will increase. Revenues are a subdivision of equity that provide information as to why equity increases. Credits will increase revenue accounts and debit will decrease the revenue accounts. Therefore, the effect of debits and credits on revenue accounts is same as their effect on equity. Credits to revenue accounts should exceed debit. Debits to expense account should exceed credits. Thus, revenue accounts normally show credit balance and expense accounts normally show the debit balance. We can diagram the normal balance like the picture below. On the revenue diagram, debit will decrease and credit will increase. And the normal balance is on right side or on credit. On the expense, debit will increase and credit will decrease. That's why the normal balance will on the left side or on debit. Next is about expenses. Expense have the opposite effect. That expense will decrease the equity. Since expense decreases net income and revenue increases, it is logical that the increase and the decrease side of the expense account should be the reverse of revenue account. Thus, debit increase expense account and credit will decrease the expense account. This illustration will show the effect of debit and credits on revenue and expense. As I explained before, debit will decrease the revenue and increase the expense. Vice versa, credit will increase the revenue and decrease the expense. The last is about summary of debit or credit rules. Let's see the illustration in this picture. This illustration shows a summary of debit or credit rules and the effects on each type of account. Let's see the basic equation. Asset equals to liabilities plus equity. And for expanded equation, asset equals to liabilities plus the expanded equation of equity that consists of share capital, retained earnings, dividend, revenues, and expense. The existing of share capital, retained earnings, and revenue will make the equity increase, and the existing of dividend and expense will make the equity decrease. Now let's see the debit or credit effect. See carefully. When some account of asset is increased on debit, it will be some account of asset is decreased on credit. Or on the other side, some account of liabilities will increase on credit, or some account of equity will increase or decrease on credit. What is increase? What is decrease? Share capital, retained earnings, and revenue will increase on credit, but dividend and expense will decrease on credit. So, what if some account of asset is decreased on credits? It must be some of account in asset will be increased to on debits. Or what can happen in the other side is some account of liabilities will decrease on debit, or some account on equity will increase on debit like dividend and expense, but for share capital, retained earning, and revenue will be decreased on debit. Finally, this is the end of this section. Thank you for watching. Don't forget to like and subscribe, and we hope you will get the point of our explanation. Thank you.
Thank you.